Hello everyone, this is Bhavik Chokshi over here and I hope you guys are doing great. In today's video, we are going to discuss some additional questions relevant for SFM theory, which comes in your main exam for around 20 marks. Now, I guess you might have seen a video that we've uploaded earlier, I think in August of 2020, where we have discussed theory from a compiler that we have prepared, whereby we have compiled questions from the MTP, RTP main exam questions of the institute all the way up to November 2020, I think May 2020. After that, periodically at every attempt, we have been sharing PDFs for the updated compiler, and we have also shared a PDF for the updated compiler as recent as April of 2022, which is relevant for the May 2022 exams. So you can refer the full PDF of the compiler from our Telegram channel, and also if you have studied from earlier compilers, we have also shared an addendum whereby the additional questions have been separately put in. So sir, what are we going to discuss in this video? Well, in this video, we are going to quickly run through questions and some keywords and important pointers for the sums that have been added from November 2020 onwards up to May 2022. So in case you don't have the time to go through the theory, the PDF, then you can refer two videos. First, the video that has been uploaded in in August of 2020, and second, today's video. So both of these videos put together, you should be on speed with the entire compiler, all the questions. Okay, so let us get started. So over here, this is an addendum of around 32 pages where we have included all the questions after the first video in this PDF, and we are going to quickly discuss that. So over here, the first chapter is about financial policy and corporate strategy. Now this is a pure theory standard or pure theory topic, and there is no sums or practical questions that come over here. So a few basic questions, a few additional questions. I think 3 questions have been added. We'll quickly run through them, focus on a few important let's say pointers. So in the July 21 exams, a question comes where the question says, state the strategy at different hierarchy levels. Now, when we are looking at strategy at different hierarchy levels, there are 3 points that you have to remember. Strategy at the corporate level. At the corporate level, you decide that what are the businesses you want to do. How do you want to enter into this business, diversify the business, etc. So the first type of strategy is a corporate level strategy where we largely have to focus on the businesses that the company should compete and how should the company proceed with these businesses. The second level is the business unit level strategy where you focus on the profit center. So it is like a division or a profit center, and how do you operate the profit center for your best results. So the second type of strategy over here is a business unit level strategy where you focus on strategic business units, which may be any profit centers which can be planned incrementally, and then from the corporate to the business level to the functional level. Functions would be something like marketing, something like finance, something like procurement, something like distribution. All of these are functions. So we have decided which businesses you want to operate it, the profit centers within those business, and what are the functions that you have to kind of excel in order to kind of ace your business. So over here, this is a functional level strategy where you focus on various functions like production, marketing, finance, human resources, research, development, etc. Okay, so there's a lot of theory over here, but the important pointers for the hierarchy would be corporate level, in which case you look at the businesses in which you want to compete in, whether they're suitable for you, whether they're feasible, etc. Second is the business unit level, where you determine strategic business units, which are basically profit centers, and kind of figure out how you want to operate them. And third is a functional level strategy, where you focus on the functions that have to be executed, like marketing, human resources, finance, etc. Okay, so this takes care of the first question, a pure theory one. Second is a RTP question in May 21. Explain the traits that an organization should have to make itself financially sustainable. Now, in order to be financially sustainable, you have to have more than one source of income. COVID-19 has shown us very well that if you're just relying on one source of income and something external, unexpected happens, you might really be taken off guard. And hence, if you want to build up a sustainable business, you have to have more than one source of income and more than one way of generating income. So over here, more than one source would be multiple activities, and more than one way would be, for example, if you're a coaching institute or if you're a media company, there is one way where you do offline classes, one way where you do online classes. So your income is still coaching income, but there are multiple ways in which you can generate that income, for example. So this is in order to have a sustainable business. Two important points. Then you need to plan regularly. The planning has to be regularly done, and you have adequate financial systems. You should have a good public image, and you should do business with proper ethics and proper value creation for your customers. You should be clear about the values that you want to create and have a good public image. So basically around 4 to 5 points also, if you remember, that is sufficient. So the pointers that we remember over here is, well, if I want to have a sustainable business, I can't really focus on one income only. So I have to have multiple incomes and multiple ways to generate, let's say, one source of income as well. You need to do regular planning. That can be strategic planning, functional planning, but you need to do regular planning. You need to have a good public image, and you need to have adequate financial systems. Clarity should be there on the values that you want to create. So these are the traits of a financially sustainable organization. A question which I would rate is not very important. Okay, and the third and the last question over here would be sustainable growth. A question on sustainable growth. So sustainable growth is important for the enterprise's long-term development. Explain the statement in context of planning healthy corporate growth. And the second question, which is in the MTP, is also on sustainable growth. So what is a sustainable growth rate? Typically, this is ROE into the retention ratio. And when we look at ROE, if you remember in your inter-CA, if you have done the DuPont analysis, then ROE in a way, okay, this risk management chapter should actually go on the next page. So your ROE will be calculated as the profit margin into the asset turnover. This is a formula which you called as DuPont analysis in your inter-CA, into, let us say, assets upon equity, also called as a debt multiplier. So over here, this is ROE into the retention ratio. So basically, if I want to find the growth, I have to try to increase my profit margin, try to increase the efficiency in which assets are used, that is the asset turnover, have a healthy debt to equity ratio, and manage my dividend properly. So these four factors will help me calculate growth on a sustainable basis. So that is about sustainable growth. So when you look at sustainable growth rate, the key points over here would be these 4 points: the profit margin, the asset turnover or the operating efficiency of the assets, the capital structure, that is debt and equity, and lastly the dividend. So these factors have to be managed in such a way that you manage to have a sustainable growth. So variables typically include the net profit margin on new and existing revenues, the asset turnover ratio, the ratio of sales to total assets, and the assets at the beginning to equity, the retention rate. So these 4 variables, you have to remember, these are the 4 variables on which your sustainable growth rate, and these are very important business metrics. Together will be your sustainable growth rate, and your focus on these variables will really help you in managing a business more efficiently. So sustainable growth models assume that the business wants to maintain a target capital structure, a target dividend payment, and increase sales rapidly in order to have a sustainable growth rate. So these are the 3 questions, pure theory questions on your first chapter. Second chapter is on risk management. So over here, when we look at risk management, here we have included various questions which may not directly be on risk management, but on risk in general. Like there may be certain questions on systematic and unsystematic risk, which are largely portfolio questions, but since they are risk, we have put it over here. In your main exam, I mean, you don't have to identify the chapter, so that's fine. So one question that had come in the January 21 paper is, risks are inherent and an integral part of the market. Now, market over here in the context of portfolio management is supposed to bear only the systematic risk. And if you have invested in the market, and if you are fully diversified, that does not mean that you are risk free. You are still going to bear risk. For example, if Vladimir Putin were to kind of declare a war on Ukraine, that affects the market. No matter how well you are diversified, it may affect the market. COVID-19 strikes, it might affect the market. And as a result, the risks are an integral part of the equity market. You can't just eliminate all the risks by mere diversification. Some risks would remain, which are undiversifiable risks, also called as systematic risk. So over here, the institute expects you to write something about systematic risk, and that is what they have explained. Risk is an integral part of the market, and this type of risk is systematic risk that affects prices of any particular share in line with the market. So basically, if you kind of give a short note on systematic risk, which is a non-diversifiable risk, which should suffice for question number 1. It's a fairly easy question. Go to question number 2. Explain how an organization interested in making investment in a foreign country can assess, that is determine, the country risk and mitigate this risk. So if you're entering a foreign country, it is important to you assess the situation. For example, if you look at the situation in Sri Lanka now, it's a slightly serious situation. So you don't want to be investing in a country which, let us say, is likely to face financial turmoil or crisis, and as a result you should assess. Now, how will you assess? Well, you will probably try to look at the political ranking of this country, the various macroeconomic conditions that are prevailing in the country. You will try to contact the embassy and understand from the our country's embassy on the potential risk of the country. So advice from the embassies, popularity of the government, and country's macroeconomic conditions can be evaluated. So these are the 4 factors that you should look at while assessing. So these are the places from where you can get inputs: political rankings, macroeconomic indicators, popularity of the government, and from the embassies. Now, if you decide to go ahead in a country and you want to establish strong cordial relations, it is important that you try to locally source products rather than importing, so that will have a very good relationship with the government, local suppliers, etc. You can develop an ecosystem. So local sourcing of raw materials, you can try to enter into joint ventures. So these people, like what Starbucks has done with Tata, these people would know the market in which they are operating well, and you can leverage or take advantage of that local knowledge. Local financing and price negotiations. So these are various techniques that can be used to mitigate or reduce. So the first part is how do you assess the risk, and in the second part we try to understand how do we mitigate the risk. Now question number 3 in the MTP over here is a very interesting question. It's a theory based question, but it is put across as a case study. So I would like this you to kind of go through this question. It's a very interesting one. Now, ultimately, what are we supposed to do? काफी बड़ा question है, but ultimately we are supposed to evaluate the major risk to which TRC is exposed based on the case study. So it's a theory thing where you have to just identify the major risk. So as we read the case, we can kind of point out to the risks that are there. TRC Cables, which is an Indian company, is in the business of manufacturing electrical and data cables, including fiber optics. While it mainly exports the manufactured cables to other countries, it has also established production facilities in some African countries due to the availability of raw material and cheap labor there. So basically there is definitely a country risk, because you are exporting as well as you are sourcing production from some foreign countries, the African countries. So there is definitely a country risk. Some major raw materials such as copper, aluminium, and other non-ferrous metals are also imported from foreign countries. So basically there is also a commodity risk. You are reliant on commodities, and these are commodities from a foreign country. The prices of these commodities might change. The regulations whereby you can import or export might change. So you are also bearing the commodity risk. Hence, overall, TRC has frequent receipts and expenditure items denominated in non-INR currencies, which means you also have currency risk, foreign currency risk, forex risk. Though TRC makes use of long-term debts and equity to meet its long-term funds requirements, but to finance its operations, it makes use of short-term financial instruments such as commercial paper, bank credit and term loans from banks, etc. Okay, so you will bear interest rate risk because you're not fully equity funded. You have some debt, and as a result, as interest rates changes, your risk can change. So you do bear the interest rate risk, and at the same time, you are reliant on short-term money from commercial papers, etc. So if the market for commercial paper dries out, a short-term money market, then you might not have enough money to pay your short-term commitment. So you are bearing a liquidity risk as well. If any surplus cash is left with TRC, it is invested in interest-yielding securities. Okay. Recently, due to stiff competition from its competitors, TRC has relaxed its policy for granting credit to manage receivables and has formed a separate credit division, which means risky risk. You are also having credit risk because you are now giving credit to the customers, and as a result, some customers might actually go bad. So there is also credit risk. Further, to hedge itself against the various risks, it has entered into various OTC derivative. OTC is over the counter derivative contracts settled outside the exchange, and hence there is a settlement risk. It is outside the exchange. So there is definitely a settlement risk. If it is on the exchange, the settlement risk is reduced because the counterparty is the exchange. However, here, because it is outside the exchange over the counter, there is also a settlement risk that the counterparty may default. So identify the various risks. So that is what we have kind of discussed: currency risk, commodity risk, interest rate risk, counterparty risk, liquidity risk, political risk because you're operating in, or that is country risk in other countries, and settlement risk. But the way in which the institute has asked this question, in my opinion, makes it slightly exam worthy. So I would rate this as important. Aja. Now question number 4 is largely a question which is linked to security valuation and your understanding of yield to maturity, YTM. So when you calculate yield to maturity, you calculate yield to maturity as the IRR, that is the rate at which the present value of cash outflows equals the present value of cash inflows. Usually, the rate at which these present values equal is IRR. We usually have the habit of taking all the cash flows to the present value. However, you can also take these cash flows to the future value. So the rate at which the future value of cash outflows equals to the future value of cash inflows can also be the IRR, by the way, the same IRR. And hence the IRR technique, in your interest, say you might have studied this in capital budgeting, your IRR technique implicitly assumes that the discounting rate is the same as the compounding rate. So for example, there is a bond of 5 years and you are getting money after 2 years, coupon after 2 years. So you will discount this coupon to find the value today. Alternatively, you can take this coupon from year 2 all the way up to year 5, for example. So which is that rate? Well, the rate at which you bring the 100 rupee coupon from year 2 all the way to year 0, or you take it from year 2 all the way up to year 5, is assumed to be the same in the IRR technique. And hence, the discounting rate is considered to be the same as the reinvestment rate, which means if this project gives me, let us say 10%, I'm assuming that the money that I'm going to invest from receive from this project, let's say 100 rupees received at the end of the second year, and if I reinvest it, I will also get the same rate. Now this is a tricky situation because well, this project might give me 10, 15, 20, 30%. That does not mean other projects are going to give me that, and hence there is a reinvestment risk. We assume that we are earning a 15% return, but this 15% return is earned if the money that you receive throughout the project is also invested in other avenues giving you the same return. If that does not happen, well, your return might be different. So that is a reinvestment risk. Over here, you're trying to study the reinvestment risk. What is the key points in the reinvestment risk? It is a risk, just a second, the important words over here would be the YTM calculation assumes that the cash flows generated during the life are reinvested at the rate of YTM. The risk here is that the rate at which the intermediate cash flows are reinvested may fall, and thereby it might affect the returns. So this is the reinvestment risk. And then second is a default risk. Now default risk, as the name goes, is very easy to understand. It is a risk where the counterparty might default. You might not get what has been contractually promised. So over here, this is the lenders and investors export to in all forms of credit. To mitigate the impact of risk, lenders often charge interest which is in line with the credit rating. Not a very important question in my opinion. And then there is a new question that has come on what you call a cyber risk. Now this is a risk that you are bearing because you are operating in a digital environment. So a risk that a company like Zomato, for example, faces in case there is a big leak of the users, which had happened, if you are aware. Zomato's users were leaked, and as a result it may be subject or hacked, for which it may be subjected to, let us say, lawsuits, litigations, etc. So this is a risk that you are bearing because you are operating in a digital environment, and in the cyberspace your data may be compromised, for which you may be open to lawsuits, legal actions, and that type of risk is a cyber risk. So this is defined as a risk of damages due to lawsuits or compensation for being a victim of the cyber attack, like what happened in Zomato. My data may be leaked in an unauthorized manner. Okay, so that takes care of risk management. Next you go to security evaluation. Now in security evaluation there has been a question which has come in the exam, which is on the principles that are used in technical analysis. The tools for technical analysis like support, resistance, candlestick, etc. are not discussed over here. It is the principles on which technical analysis rests. Like there are 3 golden rules of account. So what are the core principles for technical analysis? Now the 3 main principles for technical analysis is based on data, on charts, on volumes, on price trends. So they believe that you don't have to do any separate fundamental analysis, but the price, the volume data that is there, it discounts everything. So the market discounts everything, and hence the data which is there in the price that you are studying or volumes that you are studying has discounted everything. You don't need to separately study for other future outlooks. Whatever is there is embedded in the price. Point number 1, market discounts everything. Market discounts everything. So technical analysis generally have the view that company share price includes everything, including even the fundamentals of the company, and hence you don't need to study anything separately. If you've studied the price movement, you have kind of figured out what the price is going to change. Second, the past is expected to repeat in the future. So this is based on price and volume movements in the past, and based on that you predict the future movements. So history tends to repeat itself. So what price patterns have happened in the past are expected to happen in the future. And third, price moves in trends. So if there is a trend whereby the price has typically gone up, let us say up to a particular level, and there is some resistance after which the price falls, there is some support where which the price rises. So we are saying that the price moves in trends. So 3 crucial principles: market discounts everything, you don't need to study anything beyond. Whatever trends are there in the market, these trends are expected to repeat, and hence the price movement is considered to be in trends, and the past repeats itself in the future, so history repeats itself. So over here this is on security analysis. Next you go to security evaluation. Over here in the RTP there is a question which is asked on a company corporate structure called as SPAC. SPAC, remember, currently is not possible in India. So this is just a generic discussion which is there in the RTP. So over here the question is, can a company which has commercially no operations, can it come out with an IPO? It is not that you are a startup, you have no operations at all, you are like a shell company, no operations. Or these types of companies are also called as special purpose acquisition companies, also called as SPACs. I'll again repeat, these are not possible as we speak today in India due to ROC as well as SEBI restrictions. However, they are in existence in the US market. The question is, can a company with no commercial operations raise money via an IPO? Typically, if you're a startup, you have a business idea, some operations, you might not be earning revenue, but operations वगैरह तो होने चाहिए. So, can such a company raise funds via an IPO? The natural answer should be no. However, there are certain special purpose acquisition companies, which are companies like shell companies, which are formed, money is raised from the investors. The idea over here is the money that is raised from the investors will be deployed in certain target companies. So the money from the investors will be used to acquire certain targets, largely in the private space, within a period of 2 to 3 years. And if we are not able to find these target companies in a period of 2 to 3 years, there's also commitment that the money will be returned. Now, what these SPACs will do is, they will raise money from investors, do an IPO, list the SPAC, a shell company, and then they will find a target and merge with the target. So by this, investors can kind of get access to private companies, and the private company can automatically get listed because it is now going to merge with the public company, so it does not have to go through that hassle of listing, etc. The SPAC has already gone through that hassle, and as a result it is much more efficient and the growth can happen faster once the target has been identified. Now in the Indian context, companies which don't have operations are dormant companies, and the registrar has the right to strike their name off within a period of 2 to 3 years if they remain dormant. And as a result, a lot of times due diligence, etc. can take a lot of time, and hence SPACs are not as common as per the Companies Act because the ROC can strike off the name. Again, SEBI has not yet given a framework for these companies getting listed. It is expected the framework will come, but it has not yet come, and as a result SPACs are not popular and are not used in India. However, they are used internationally for acquisitions, especially of private companies being acquired ultimately, which want to get listed and don't want to again go through that listing process. So and investors wanting access in listed companies, but ultimately this company is going into the private space. So this is SPAC, a lot of theory given by the ICAI. A few important words would be what is SPAC? SPACs wherein an entity is set up with an objective to raise funds through IPO to finance a merger of an unidentified target within a specified time. It can also be called as a blank check company. Then the current regulatory framework in India does not support SPAC transactions. The reason being ROC is authorized to strike off the name of companies that do not commence operations within 1 year, and it is very difficult for SPACs to kind of identify a target and get operational within a year. SPACs also do not find acceptance with the SEBI as they don't meet the eligibility criteria for public listing. So it is more of an international phenomenon and a concept that you just need to know that should be there. So SPAC has certain advantages, if you go to see, would be giving access to capital and markets directly, lower transaction fees, and an expedited timeline. Everything wants to be done fast over here. So over here, the company which is a target can kind of quickly list indirectly, which is okay. Again, there are some challenges, and the challenges would be complex accounting and financial reporting requirements, like reverse merger requirements. If you've done in your financial reporting, why it can probably come over here, which is fairly complex, and it is sometimes more expensive because you have a layer already and then again a merger. So आपका double cost होगा, पहले अपने listing के लिए पूरा खर्चा किया, फिर then merger, so it may be slightly more expensive. Okay, so these are a few things that you should know. Obviously, this will be a 4-mark question. It is impossible that even if you remember all that is printed over here, it's not even advisable to write so much data for 4 marks. Okay, next we have something called as quant fund. What is the question? This is an MTP question. An interesting thing, the idea of a quant fund is stock picking free from human intervention. Now, this is a trending concept these days. What is a quant fund? This is like algorithmic trading. So you will kind of set up a model, and in that model you will have various inputs. So you will probably look at the GDP, the interest rate data, index of industrial production, or certain data, and based on which you will tell a computer that these are the quantities that I am putting in. If certain thresholds are met, you can automatically buy. Certain limits are crossed, you can automatically sell. We are not going to physically buy and sell. So this is computer related trading. So human biases, probably the slow speed at which or distractions which humans have can kind of be overridden by quant funds. So is quant fund like a static fund? No. The inputs, the parameters that you have defined for a quant fund, like the GDP target, the inflation target, etc., you will check this for robustness. You will see whether these estimates are robust enough, and if not, you can change the model. So it does not really mean that this is like passive investing. This is stock picking, जहाँ पे एक बार अपने model बना दिया, कुछ देखा नहीं. No. You have to keep on seeing whether the model that you have developed, is it a robust model which kind of takes care of all the recent changes as well, and as a result it is not completely free of human intervention, but yes, it does remove human biases, etc. So over here, quant fund, what is a quant fund? It is a data-driven approach for stock selection or investment decisions based on a predetermined rule or parameter using statistics or mathematical models. So this is a quant fund. It does not mean that there is no human intervention. The fund manager focuses on the robustness of the models in use and also monitors their performance. ऐसा बोलना गलत है that there is no intervention. Computer will buy and sell, but whether the model use is robust or not, you have to see. The main advantage of quant fund is that it eliminates the human's biases. So this is something that I would rate as important, and also ensures consistency. Also, the disadvantage over here is that the quant funds are based on historical data and past trends, and you can't blindly trust them because what happens in the past may not necessarily be repeated in the future. So these are a few important things that you can kind of focus on while drafting your answer. Then there is a question where you are being asked on whether duration correctly predicts price. Typically it does. However, duration has a linear relationship to price, which means if the duration, for example, is for example 3 and the change in interest rate is, for example, 1, then we assume that if the interest rate, let us say, decreases by 1%, then the price will increase by 3%. If interest rate decreases by 2%, price will increase by 6%. Interest rate decreases by 3%, price will increase by 9%. So it's a linear movement. However, if you actually sit and calculate the numbers, let us say your current yield is 10%. Now the price at 9%, price at 8%, price at 7%, the change will not be exactly 3%. As the interest rate changes, the duration itself undergoes a change, and that is called as convexity. So if you actually build up the curve showing the change between the relationship between the price and the interest, you will see the curve is of a convex shape, not a straight line, and that difference is called as a convexity. There is a question that had come on convexity also, I think in the November 20 exams, and you might have probably studied this, but this is the theory for that. Modified duration is a proxy, not an accurate measure of change in the price of a bond due to changes in interest rate. Discuss. The reason over here is convexity. It is a convex nature of the curve for which duration does not exactly take. Duration gives you an approximate measure of price, though not an exact measure of price, because duration assumes a linear movement. So over here, modified duration is a measure of volatility based on the bond's price consequent to a change in yield. This is okay. It assumes a linear relationship between the duration and the price, but it is not an accurate measure because of the convexity. Because the price movement actually, if you go to see, is this convex movement. You assume that the movement is going to be linear, and hence the difference over here, for example, is arising because of the convexity. Okay, fair enough. So this is question number 3. If you understand convexity, you will understand this question, otherwise you will not. Money markets, this is a relatively new thing in the new syllabus, which was there in the security valuation section probably a year or two earlier. This has been introduced. This is like commercial paper or repo and reverse repo or kind of certificates of deposits. What are money markets? Money market has been very popularized. If you have seen the Scam 92, यहाँ पे money market का बहुत बड़ा बात हो रहा है. So probably it has been glamorized and popularized due to that web series. But nevertheless, a money market is nothing but a short term, a market where short term money is needed, and the trading happens in fairly high volume. The transaction costs are relatively low. Participants are of a very with deep pockets, banks, financial institutions, etc. For short-term money, very short-term money, less than 1 year in all likelihood. Money market can be defined as a market for short-term money and financial assets that are near substitutes for money with minimum transaction cost. Achha, this is up to 1 year. This is an important thing. So it is very short-term for up to 1 year. It typically has lower cost, and it provides reasonable access to users of short-term money to meet their requirements at realistic prices. क्या रहता है आपको थोड़े टाइम के लिए पैसा चाहिए, suddenly चाहिए, people can exploit you. So over here, this is a market where money is available for short-term requirements only. Fair enough. Then are sustainable growth rate and internal growth rate same concepts? I don't think this question is important. It is kind of, it's a self-defeating question over here. What is internal growth rate? What is sustainable growth rate? Internal growth rate is sustainable growth rate, as we have said, is the ROE into the retention ratio, is dependent on various factors like the profit margin, the asset turnover, the capital structure. Internal growth rate is like the your ability to earn return. So it is like the IRR, for example. They are similar, but may not be exactly the same. I don't think it's a very well worded question nor a solution. आप एक बार फटाफट glance through करके निकल सकते हो. अच्छा, this is an exam question from the old syllabus, which is on repo and reverse repo, which can very well come in the new syllabus as well. What do you mean by repo? The full form of repo is a repurchase, which means like RBI and a lot of 64, I think, major players can enter into a repo transactions where, let's say if I'm an RBI, I can actually enter into an agreement where I'm selling my securities, receiving that money. So I'm borrowing as an RBI and selling securities, receiving money, and at the same time agreeing to repurchase the securities after a few days or weeks, and thereby on repurchase paying that money back. So this kind of absolves you from a lot of paperwork, formalities of putting a security, etc. You enter into a sale transaction, and on that date enter into a repurchase transaction at a predetermined price. The transaction gets done fairly fast. This transaction can be done with the RBI or between 64 registered players in the repo, reverse repo market, which include these big names like ICICI, HDFC, Axis, etc. So repo is a case where this transaction is viewed from the perspective of a person who is selling the securities and agreeing to repurchase. Reverse repo is the same transaction but viewed from the perspective of the other party. So a person who is kind of buying the securities but then is supposed to give, is not going to repurchase, rather he is going to give the securities. It's like a reverse transaction. So that is a reverse repo. So over here, what is repo and reverse repo? Where money market raises funds by selling securities and simultaneously agree to repurchase them at a specified time at a specified price. Selling and agreeing to repurchase. Are we clear with this? Yes, okay. Next, you go to portfolio, a very basic question over here involving systematic and unsystematic risk. I really hope that at this stage you know the difference between systematic and unsystematic and how to kind of differentiate. Systematic risk is the overall market risk. Non-diversifiable risk will arise even if you invest across the market, cannot be eliminated, arises due to generic macroeconomic factors and not company or industry specific factors. On the other hand, unsystematic risk is a diversifiable risk, arises due to company or industry specific factors, can be reduced due to diversification, and will not be present in a well diversified portfolio. The measure of systematic risk is typically beta, whereas the measure of total risk is standard deviation, and unsystematic risk can be treated as random error. Okay, so this is about systematic and unsystematic. Next, you have certain strategies. So there are three strategies. You might have studied this in portfolio or mutual funds. This is buy and hold strategy, where you buy the share and then hold it. You don't do any change. Second is a constant ratio strategy, where you buy, let's say, certain shares and certain debentures, and you have a target ratio in mind. Let's say 50-50 to debentures and equity, and you try to manage the portfolio in such a way that that ratio is met. You try to check for this at regular intervals, maybe a few weeks or maybe a month. If the change is beyond, let us say, accepted limits, let's say more than 5 or 6%, then you can rebalance in such a way that if your portfolio has deviated, abhi 60% equity ho gaya, 40% debt ho gaya, then you can probably sell the 10% equity and put 10% money in debt. So that is a constant mix or constant ratio policy. And then there is CPP, a constant portfolio insurance or constant portfolio insurance strategy or policy, in which case there are various ingredients, like you have the floor value. So let us say you have a 3 lakh rupees portfolio and you want to invest it for a period of, let us say 6 months, 12 months. What is the maximum money that you can afford to lose? Let us say you can afford to lose 10%. So 3 lakhs minus 10%, that is 2 lakh 70 will be your floor, and hence 30,000 for example is the cushion. So 3 lakh rupees है, 2 lakh 70 के नीचे आपका portfolio जाना नहीं चाहिए, so 30,000 is a cushion, and you can invest that cushion in equity. कितना invest करेंगे depending on your risk taking capability. So the cushion is basically or the investment in equity is the cushion value, that is 30,000 into the multiplier. Multiplier your risk taking ability. If you are a risk averse person, then multiplier will be 1. 30,000 ka cushion, you will invest 30,000 in equity, the remaining 2 lakh 70 will be in bonds. If you are a slightly risk taking person, then you will take the multiplier, let's say of 2, in which case 30,000 into 2, that is 60,000 will be deployed in equity, and 2 lakh 40 for example will be in bonds. At each rebalancing date, you will again try to recalculate the cushion available. So for example, the equity value which was 60, it performed fairly badly and it came down to 55,000, let's say 60,000 आपने invest किया तो उसे 45,000 होंगे. Bonds continue to remain at 2 lakh 40. So basically your values now will be 2 lakh 40 of bonds plus for example 45,000 of equity. So 2 lakh 85 of portfolio, your floor is 2 lakh 70, so 15 is the cushion into 2, 30,000 equity में रह सकता है. Your equity currently is 45, you will still sell 15,000. There are problems for this. I hope you would have done that. So what does question number 2 ask you? Explain the strategy of portfolio rebalancing. Rebalancing can be the constant ratio strategy or constant mix strategy, where you have a target debt to equity ratio and you have to meet that, or CPPI, constant portfolio performance or insurance, under which the value of a portfolio shall not fall below a specified value in the normal market conditions. And second, which has come in the exam, buy and hold is one of the policies of portfolio rebalancing. Briefly explain other policies of portfolio rebalancing. So the other policies are constant ratio, constant mix, where you have a mix of debt to equity, target mix of debt to equity, and you will try to check whether that mix is maintained at predetermined rebalancing dates, and if they have not, you will take rebalancing actions. So over here, so exposure to stocks is a constant percentage of the portfolio only. Constant proportion insurance policy. So over here it's best understood with sum. If you have done, you calculate the floor, then you calculate the cushion, then the equity investment is the cushion into the multiplier as given to you, and you will keep on rebalancing based on the equity values etc. at each rebalancing date. Okay, so that takes care of portfolio. Next you go to mutual funds. Now what is a tracking error? Tracking error, as the name goes, over here describe tracking error and list the reasons for it. As the name goes, tracking error is the error that you kind of see in something that you're tracking. So this is largely for index funds or passive funds. For example, you want to invest in Nifty or you want to invest in Sensex. Now Nifty has 50 shares. Now some people might say that rather than investing directly in Nifty, which may not be as available, because Nifty is just an average, there are certain funds which track the Nifty. So whatever are the constituents of Nifty, these funds will invest. But they would say that no, I don't want to invest in all the 50 shares of Nifty. If there are 5 banks in the Nifty, I will invest in 2 of them. For example, SBI, which represents the public sector banks, and HDFC Bank, which might represent the private sector banks. So I might not invest in all the other banks like ICICI, Axis, etc. because otherwise, if I take small stakes in all of these, there will be a lot of transaction cost. Whenever there is a rebalancing or a change, you might have to kind of incur a lot of transaction costs and managing 50 shares. Instead of that, if there are 10 sectors which represent these 50 shares, I will use probably 1 or 2 companies in each in order to kind of build my portfolio. This is how a lot of passive mutual fund managers invest. Ideally, you should invest in all the 50, but that will make it a little more costly. So you might kind of selectively select companies. In this case, it is possible that because you have not exactly taken the exact same shares in the same proportion that are there in the Nifty, there might be some error. And the amount higher the error, higher is the risk, because then your portfolio is not really tracking the benchmark, that is the Nifty or Sensex, that it is following. So higher the tracking error, higher is the risk. Your mutual fund or your portfolio does not really represent what it kind of primarily intends to track. So tracking error can be defined as a divergence or deviation of a fund's return from the benchmark return that it is following, like Nifty, etc. The reasons for tracking error, higher the tracking error, higher is the risk profile. The reasons can be because you want to reduce some transaction cost, some sample that you have selected, cash balance that the fund might have kept aside and not invested. So all of these are probably reasons. The charges which are levied by AMC, which is not there in the Nifty. So all of these may be reasons for the tracking error. So what is tracking error? The difference between the return generated by the entity's portfolio versus the actual return of the portfolio or the benchmark, that like the Nifty, that it is tracking. The reasons may be because of transaction cost, maybe because of the fees that the AMC is charging, maybe because it has kept aside money for cash and hence not invested, and maybe because of sampling, like instead of 5 banks you have taken just 2, that is a sample, and because of that there is this error. Acha. So that is about tracking error. Now derivatives, you have a question on commodity swaps are characterized by some peculiarities. Now this is just a generic statement, because commodity markets are very different from regular financial markets like currency markets, share markets, where there are a lot of financial investors. Commodity markets depends on the nature of the commodity, the participation, the liquidity is a very important barometer. Like in commodities like gold, oil, etc., there is a lot of liquidity, there are a lot of participants. However, in a commodity market, which may be something like a urad dal market, there may not be enough participants, and hence liquidity, etc., may be a very important consideration. There may be a few large suppliers and a lot of small buyers, very less speculators, relatively lesser arbitrageurs. So you will have to look at the nature of these commodities. Like oil and gold, for all practical purposes, are as efficient as the equity or the currency markets, but that cannot be said for every commodity because of the nature of participants, liquidities, etc. So commodity swaps are characterized by some peculiarities because of the cost of hedging, the institutional structure of the commodity, the liquidity, the most important thing, of the underlying commodity, seasonality, which is there, seasons are there in commodities, it is not really there in equities, brokerage fees, credit risk, etc. Some of these factors must be extended to pricing and hedging of interest rates. The idiosyncratic nature of the commodity markets refers to the limited number of participants in this market. So this is a major problem. So the 3 or 4 important, the 4 important peculiarities, if you have to write, would be the structure of the market, the institutions that are participating, whether there are big institutions, whether there are manufacturers, whether there are genuine buyers, speculators, the liquidity in the market, the seasonality of the commodity, the credit risk, and the capital cost and administrative costs. And all of these are basically because of different commodities having different market participants. Acha. Foreign exchange, there is just one chapter, one question. Again, this is something which is linked to a numerical question. If you remember, there is a sum on Nostro, Vostro, and Loro, in which case we prepare what is called as a cash position and an exchange position. What is there in the cash position? In the cash position, you take only the actual cash movements. The actual cash movements, like the money received or the actual remittance made. Like forward contract taken or a forward contract cancelled, etc., will not affect the cash position, but it will affect the exchange position, because exchange position takes your overall exposure to a particular currency, maybe due to actual remittances or maybe due to a commitment to buy or a commitment to sell. So what does question ask you over here? All the dealings in foreign exchange affect the exchange position. all the dealings. That is correct, whether delivery has been taken or not, but cash position is affected only when actual delivery has taken place. That is correct. The statement is correct. The exchange position, this statement is correct. And you can refer that one sum that we have, I think right at the very end, even in your material, where you have the Nostro account or Vostro account, where you, in the cash position, you have taken the actual remittances, whereas exchange position, you have taken the actual remittances, and along with that, certain bills, drafts, forward contracts taken, etc. are considered. So exchange position overall, cash position only the actual remittances. Okay, now the next question on chapter on international financial management in your old, so a lot of questions from the old syllabus over here, which I would not really rate as important. So this is from the old course, like euro convertible bonds, project appraisal in inflationary conditions, huge questions and solutions being given. So this is not really important. It is from the old course, but it's not that it is not applicable to the new course, but they are not as important. So when we look at euro convertible bonds, these are nothing but bonds of the foreign market which are convertible. So these are bonds issued by Indian companies in the foreign market with an option to convert them. So like a foreign currency convertible bond can also be called as a euro convertible bond. These bonds might have call options or put options. Call option is an option which is available with the issuer, whereby the issuer can call and redeem the bond earlier. Put option is the option which is available by with the holder, where the holder can put the bond and demand an early redemption. So these bonds can have these option features as well. Project appraisal in inflationary conditions, a very generic question, but a huge, humongous solution printed by the institute for this. So you don't have to write such a big solution. It's just that you have to remember that whenever there are inflationary conditions, inflation has to be considered in the project evaluation. It has to be considered while determining the discount rate, while determining the future cash flows, while determining the future selling prices, variable costs. It has to be considered, and the effect has to be given both in the cash flows as well as the rates. So over here it is advisable to make provisions for cost escalations when you are operating in a country where inflation is a very important factor. Sources of finance should be properly scrutinized so that you kind of ensure that your inflation is properly managed. Adjustments should be made in profitability and cash flow projections to take care of inflationary pressures. So your cash flows should be after inflation, and the viability of project at revised rates. So you will have to kind of simulate various rates of inflation, and based on that figure out whether the profitability of the project is there or not. Preferably in an inflationary scenario, projects which have early payback periods are preferred because you can recover your capital faster. Okay. And in order to adjust inflation, you can use the following approaches. You can adjust cash flows with an inflation index, or you can adjust the cutoff rate, or what you call as discount rate, to give effect to the inflation. So this is a generic question. The next question, question number 3, is interesting question. I would 3 and 4 I would really rate as important from this section. Both 3 and 4 can come in your new course exam as well. So when you look at question number 3, this focuses on the difference between what is called as project cash flows and parent cash flows. So there exists a vast difference between a project cash flow and parent cash flow. What are these factors? Now, what do you mean by project cash flow? So for example, if you are a US company like Tesla, for example, and you are investing in an Indian project to manufacture cars in India, when I look at the project cash flow for Tesla, I will look at how Tesla's project in India fares vis-a-vis the Indian competitors. I will not look at the foreign currency risk. I will not look at the foreign competitors of Tesla, which can probably come in India, etc. No, I'm just looking at the Indian competitors like Maruti, Hyundai, etc. And I'm looking at the cash flows in rupees. Tesla India might earn profits in India. It might repatriate those profits back to the US, to its parent, whereby there are withholding taxes, or there may be restrictions. All of these are ignored in project cash flows. You have to just evaluate the feasibility as a Indian company investing in an Indian project. You don't have to look at those additional factors of remittances, tax, double taxes, etc. You don't have to see that. In a project cash flow. But when you look at a parent cash flow, you have to consider both. Apart from the viability of the project in a country, you have to predict exchange rates, you have to look at taxes, you have to look at restrictions on repatriations. All of that will be looked at. So when you're looking at the project cash flows, it is as if you are investing in an Indian company and comparing with the Indian competitors, whether the project is viable from an Indian perspective. Whereas in parent cash flows, along with the project cash flows, you also have to consider the impact of taxes, the impact of currency, the impact on restrictions that you might have on repatriation. So it is a much more overall assessment, not just considering the operations of Tesla India, but also considering these other factors like restrictions, currencies, which may impact the project appraisal. So over here, we say a project on the basis of own cash flows, that the project should compete favorably with domestic firms and earn a return higher than the local competitors, better than Maruti does. Is this project capable of earning a better return than Maruti, Hyundai, etc.? If not, the shareholders and management of Tesla, that is a parent company, shall rather invest in the equity of domestic firms. So rather than, if Tesla India is unable to beat the performance of Maruti or performance of, let us say, Hyundai, then might as well I will directly invest my money in Hyundai rather than setting up a company. A comparison cannot be made since with foreign firms, since they are imports. For evaluation of foreign project from the parent's point of view, so this is over here we are discussing about project cash flows, whereas here we are discussing about parent cash flows, where you have to look at these factors additionally. We have to look at operating and financial angle for cash flows actually remitted on the basis of distribution of dividends, repayment of debt or interest, tax. All of these have to be considered. Okay. Then you go to question 4. Explain the problems that are faced in international capital budgeting decisions and how they can be overcome. So there are 3 main problems in international capital budgeting. जो parent cash flows के जो 3 problems अपन ने discuss किए थे, वो largely these are the problems over here. First is the forex risk. If you are doing international capital budgeting, you have to predict the rate of exchange that may possibly there in the future, for which you might have to kind of consider interest parity theory, you might have to predict inflation, etc. So over here, this is subjected to foreign exchange risk, and in order to incorporate the foreign exchange risk, you will have to predict the inflation rates, make adjustments for inflations, etc. Second is taxes. So over here, when you look at taxes, especially double taxations, you might have, certain countries might have double taxation avoidance agreements, certain taxes might not, certain countries might not. So you have to look at the impact of taxes on whether will you be taxed in the country where you are operating as well as the country where you are residing double, or if not, how will the tax reduction happen. So multinational will have to look at tax structure, so the presence of 2 tax regimes and tax treaties, etc. will have to be seen. Your objective should be to reduce the overall tax burden. And third is the restrictions, like what happened in Russia. If you go to see on the war, Russia had a lot of reserves in dollars. It is now restricted from repatriating its own money reserves back. So that is very well a risk that the Russian companies, if they were operating only in Russia, they would not be bearing this risk. And hence, when you're doing a multinational evaluation, you have to be evaluating that will this country or can this country potentially restrict from me repatriating my own money. So restrictions on repatriation will also have to be seen. Due to restrictions on transfer of profits, etc., your money can be blocked, and you will have to see what is to be done with those blocked funds. Foreign exchange risk, the risk of the money repatriation, and taxes should be additional considerations in a multinational or international capital budgeting decision. The last question over here is on netting and matching. in foreign exchange, there's a technique whereby you can net and match. So there can be a company like Coca-Cola, which has hundreds of subsidiaries spread across the world, various transactions between these subsidiaries. Ideally, you will have to settle each of these transactions. What Coca-Cola might do is, rather than every company of Coca-Cola paying to another subsidiary of Coca-Cola in another country, it will net out the exposures. It will convert all of these receivables or payables between individual companies into a single currency, which is typically the parent's currency, and just require payments for the net amounts. What that will greatly do is it will reduce the transaction cost, that bid and ask problem. It will reduce the transaction cost and probably save some costs for the company overall. So the technique of optimizing cash flow movements and minimizing the total volume of intercompany fund flow, reducing the intercompany fund flow with the combined efforts of subsidiaries is a need of the hour. Discuss. Generally, क्या लिखा हुआ है? Netting helps in minimizing the total value of intercompany fund flows. Yes, it does. You will net off the exposures after converting them into the parent's currency, and only the net cash flows will help you in greatly reducing transaction costs and bringing efficiency in your cash management processes. So over here, this will help in reducing transaction administrative costs resulting from currency conversion. The advantages would be reducing the number of cross-border transactions, reducing the need for foreign exchange conversion, improves the cash flow forecasting, and these are the main benefits. Okay, so that takes care of international financial management. Next, you go to interest rate risk management. So we go to the next section, that is interest rates. And interest rates, there is something called as swaptions. Now, as the name goes, what do you mean by swaptions? Swaptions is an option to enter into a swap. So that is what you call as a swaption, whereby you get an option to enter into a swap. So what is a swap? Maybe you are paying fixed, receiving floating, or you are paying floating, receiving fixed. However, you enter into a swap. Here, in case of a swaption, you enter into an option so that you can enter into a swap. So probably if it is a 5-year, let's say it's a 3-month, 5-year swaption, it means that after 3 months, so 5-year 3-month swaption, it means that after 3 months, you have an option to enter into a 5-year swap, whereby you can either agree to pay fixed, receive floating, or pay floating, receive fixed, as the case may be. So over here, it's just an option to enter into swap based on the designated terms. So an interest rate swaption is simply an option on interest rate swap. It's an option to enter into an interest rate swap, and it gives the holder a right but not the obligation to enter into an interest rate swap at a specified date. So that is what you mean by a swaption. Okay. The principal features of a swaption are: it is effectively an option on a forward IRS. IRS is an interest rate swap where the exact terms such as the fixed rate of interest, the floating reference rate, and the tenor of interest rate are established upon the conclusion of the swaption contract. So if it's a 3-month, 5-year contract, so after that 3 months, you will exactly decide the terms, but you have an option to enter it into this swap. Okay, the option, so a 3-month, 5-year swaption would therefore be an option to enter into a 5-year IRS 3 months from now. Okay. What is the option period? Option period is the time that is between the transaction date and the expiry date, and swaption will be having some premium, and this premium is expressed as basis points. These swaptions can be cash settled. So these are general things, but basically the swaption, you don't really have full-fledged sums on this. You have sums on options, you have sums on swap, but this is an option to enter into a swap. So this, if it comes, will probably come from a theory standpoint. Achha, in your, so this is a July 21 theory based exam question. Now it's a December 21, again a theory based exam question. This is an easy one which is based on FRA. What is a FRA? FRA is basically a forward rate agreement. So you are entering into an agreement with a bank whereby you are agreeing to either borrow or lend, as a case maybe, at a specified interest rate after a specified number of years or a specified number of months. Now in case of a FRA, this is not exchange traded. In all likelihood, the FRA will be net settled, which means whatever is the interest, you will not actually, the bank is not going to actually give you a loan at that amount. the bank will just settle through difference in interest rate. So if it's a 100 crore principal, then at the let's say it is 1 year FRA, so it is, let us say, a 12 by 24 FRA, that is after 12 months you can borrow for another 12 months, let us say, at the FRA rate. So if the FRA rate is 6% and the market rate of interest after 1 year is 8%, then 100 crores into 2%, that is 2 crores, is what the bank will pay you. If the actual rate becomes 4%, then 2 crores you will have to pay to the bank. However, you have to pay this amount at the end of the tenure. Interest has to be paid at the end of the loan. So at the end of the 1 year loan, you have to pay this. However, in most cases, people usually settle on the fixing date only. So ideally, at the end of 12 months, you will take a loan for another 12 months. So interest has to be paid at the end of the 24th month, that is after 2 years. In this case, people would say that why do wait for another 12 months? We know कि कितना amount pay करना है, 2 crores, right? So let us settle at present value. So you will take the present value of 2 crores and according to that settlement will happen. So what are the main features of a forward rate agreement? What is a forward rate agreement? It is an agreement between two parties through which a borrower or lender protects from an unfavorable change in the interest rate. Unlike futures, FRAs are not traded on an exchange and hence are over the counter, also called as OTC products. They are usually used by banks to fix interest costs. It's an off-balance sheet instrument, does not involve any transfer of principal. It is going to be net settled. It is settled in maturity in cash, representing the profit or loss. So that 2 crore profit or loss is going to be settled, and the final settlement amount can be calculated as the notional principal. For example, in our case, 100 crores into the reference rate minus the forward rate. So reference rate is, let us say, 8% minus the forward rate is 6%. So 2% into, let us say, 12 months. So this is 12 by 12. This is going to be the amount of 2 crores, but this is 2 crores that is to be paid at the end of the borrowing tenure. We will probably settle it today only. So this is 1 divided by, let us say, the rate of interest today is 8%. So 1 divided by 1.08, and that will be the settlement value in case of a FRA. Okay, the differential amount is discounted at the actual interest rate, like 8%. If 6% was the FRA rate and rate has become 8%, and it is settled at the beginning of the period, and it is not settled at the end. Are we clear with this? Yes, okay. So this takes care of interest rate. Next chapter is on corporate valuation. So the question over here is, explain how cash flow based approach of valuation is different from the income based approach of valuation, and explain the steps involved in this approach. See, in case of an income-based valuation, you are focusing a lot on accounting concepts, on certain non-cash items like depreciation as well, and accounting concepts. Whereas cash flow-based projection is based on the actual cash flows that are freely available, that you are capable of generating, and does not include items like non-cash expenses, etc. So what is more superior? Generally in the industry, people prefer cash flow based approaches because cash cannot be manipulated. Cash is actual in nature, whereas income based on the accounting policies can also be altered. The typical method that you use for a cash flow based valuation, like what you do in discounted cash flow analysis, DCF, what you call it, is you will first have to find the method to be used for measuring cash flows. Can be free cash flow to the firm, free cash flow to the equity. You will try to project these cash flows, let us say for an explicit period, let us say 3 years, 5 years as the case may be. And once you project these cash flows, then you will also try to find the relevant discount rate, discount these cash flows. However, the value of a company is a present value of all the future cash flows up to perpetuity. You have probably taken only 5 years. Then beyond that, you will take the terminal value. For the terminal value, you will take help of a method like Gordon's formula and try to find the present value of all the future cash flows, let us say up to perpetuity. That is the terminal value. Discount the terminal value and get the answer. So this is like the multi-stage growth model. So the essential steps in DCF based valuation is arrive at the free cash flow, forecast or project the free cash flow, determine the discount rate, find the terminal value, and find out the present value of both the free cash flows and the terminal value, and that is what you will get as a value from the DCF. Okay, so cash flow based approaches take into account the quantum of free cash that is available and discount them to match the company's risk. So this is the general description on a cash flow based approach. Okay, The next question over here is on MVA versus EVA. Now, what is the MVA? Market value added. Market value added looks at the total market value of your securities, like the market value of your equity shares, market value of your debt, etc., and compares it with the book value. Whereas EVA is like the income statement approach, where it looks at the operating profit that you have generated and compares it with the minimum profit that you expect. So market value added over here looks at value creation on an overall company basis and not just on a per year basis. So when we look at a market value added, it is a much more broader concept and an as on date concept, whereas EVA is for each of the years. So over here, MTP 21 question, market value added is an attempt to resolve some of the issues in EVA. EVA probably does not give you a full picture of what is the impact of total value added. It is just year by year, whereas market value added probably will give you that entire cumulative picture. So MVA represents market views regarding the company's future value generation, whereas EVA is just the performance in a particular year. Companies with a higher MVA will become, let's say, the darlings of the share market and would eventually become pricey. In such cases, the EVA may sometimes have a slightly negative correlation with MVA, but this will be a short-term phenomenon, that is okay. The main objective of an EVA is to show the management efficiency in generating returns over and above the hurdle rate of the invested capital. This is for a particular period. MVA is the position as on a particular date. Okay. Next, third question and the last question over here would be relative valuation approach is a significant departure from intrinsic value approach. In intrinsic value, what we typically do is you take the present value of future cash flows. That is the intrinsic value approach, whereas in a relative valuation approach, you use as comparables. So over here, you don't really look at your fundamental future growth rates, future projections, no. You look at your number and you kind of say that, okay, if someone else in the industry is earning a P multiple of 10 times, then you should ideally also, if you are similar, have a P multiple of 10 times. This kind of, it's very different from intrinsic value. You are looking at someone else as a base, and based on that, you are determining your own value, as compared to intrinsic value method, where you don't really care what others are earning and what is the value of other companies. You look at your core financial factors, and based on that, you decide what is the value. So over here, they are different, but relative valuation kind of sets the expectations right. So when someone comes to you and demands any arbitrary number, you can always say, counter it, the discounted cash flow, by saying that, okay, well, you know what, there is a similar competitor which is available at a specific value, then why should I invest in your company? So it sets a very good base, a benchmark for valuation. So in this case, you identify assets which are of similar nature and get a value that is nearest. Try to get a value that would be nearest to the market price to mean that the valuation would happen at an agreeable price. So over here, relative valuation, I don't think there is a lot of keywords that you can remember. Over here you can write your, so this is basically valuation by multiples, uses financial ratios to derive at the desired multiple as compared to the comparable firms. It is different, but it is not that it is wrong. It helps in setting the base fairly well. Okay. Next you go to mergers and acquisitions. So over here you don't really expect a lot of questions on theory, but you will get a numerical, but just in case it comes. So this is an RTP question. Unrelated companies come together to form an entity. What relationship is it called? Well, in this case, it is like a conglomerate merger. So two completely unrelated companies, they come together, like there is Unitech, which was on, which is manufacturing or which is in real estate, and there is a company which it merges in order to, let us say, set up a telecom business like Telenor or Uninor. Now, this is a completely unrelated business. The features of such entities, such types of mergers are called as conglomerate mergers. The idea for doing a conglomerate merger is typically to diversify the risk. So if there's a company and it is operating in a particular business, if it wants to diversify risk, it can enter into conglomerate merger. For growth, expansion, future outlooks, conglomerate merger can be done. So over here, That is about conglomerate merger. Second question, cross-border M&A is a popular route for global growth and overseas expansion. Yes, it is, and yes, we do agree. A lot of action is happening in India as well on cross-border M&A. It is, especially for developing countries, it is a very important route. Helps in globalization, helps access to good goods, cheaper materials, cheaper labor, etc. So it is a very good way for overseas expansion for companies. Let us say in the US, they go to China, India, Thailand, etc. for lower cost, and Indian companies can probably Indian countries can generate employment. Probably overall goods can be manufactured at a cheaper price. It is going to facilitate. Governments are also supporting by having supportive policies. There is now an integration between global economies. If let's say the Dow Jones opens lower, the Indian stock markets might also have an impact. If Asian markets are not doing well, the developed countries market also have an impact. Government is also doing privatization in order to encourage global companies, etc. to participate as well. Achha. Demerger or division of family managed business. Again, these are all old syllabus questions. You barely see any new syllabus question here, so it's not as important. So we can kind of quickly go through. India, more than 80% of the businesses are family managed, and there's a lot of pressure on them to kind of let the private professional managers take over. And as a result, demerger is one route where a family managed management is unable to manage. So they can demerge, and in the demerged company, they can get professional managers. Or if there are loss-making companies and you want to turn around these loss-making companies, you can demerge and get professional managers to help in turning around. Or you can do a demerger and probably do an IPO of a fairly successful company, or you can enhance focus on that particular company as well. So various reasons for which demerger is done, probably to keep aside the loss-making companies, better focus, better management, to kind of sell a particular operation, or have better management structures. So this is for demerger. The types of mergers, you've probably discussed this even while doing our SFM practical section. Horizontal merger, where two competitors merge. Vertical mergers, where in the supply chains, let's say buyer or your seller or your creditor or your supplier merges with you, that is a vertical merger. In a conglomerate merger that we were just discussing, completely unrelated sectors, you can potentially enter. A reverse merger is a merger where, let's say, a private company acquires a public company, or a smaller company acquires a bigger company. And a generic merger is a merger whereby two companies are connected through, let's say, something like some common technologies or something, where a merger can potentially happen. So relating to basic technologies, production process, or market as a case, maybe that is a generic merger. So these are the different types of mergers. Then there is again an old syllabus question on buyouts. What is buyouts? You are buying out and acquiring the entire company. Two common types of buyouts. There can be something called as leveraged buyouts, also called as LBO, where the acquirer takes a huge amount of debt and through that money buys out a company. Or MBO, a management buyout, where the management team, the CEO, CFO, etc. come together and buy out and become owners of a particular company. So buyouts have been happening fairly frequently. The number of buyouts, etc. are increasing, in order to kind of, mainly done by private equity venture capital funds, in order to get quick returns and kind of pivot or turn around the companies fairly fast. So this is the general discussion on buyouts. Mergers and acquisitions, in my opinion, not really important from a theory standpoint. You see almost every question is from the old course, nothing in the new course. And then you go to the last chapter, I guess, which is on startup finance. This is fairly important from an exam standpoint. Securitization is also important, but all the questions on securitization in the recent attempts or institute material is from the older material that is there in our compiler, so I don't think we need a separate discussion for that. So startups, explain the indicative risk matrix of each stage of funding for venture capital financing. So there are various stages. This is an exam question. I would rate this as important as well. In the MTB, a slightly different question, but almost the same solution. For a venture capitalist, while risk is different at each stage of financing, the risk perception and activity has to be financed. Explain the statement. So basically, you're trying to show the risk at various stages. Now, what are the stages? The first stage is the seed money stage, where you are at a you are at a completely idea stage. So you need money for the idea, for doing R&D, for developing the product. You have not even started selling. Second is the startup stage, where you have started making prototypes or models. You need money for products and marketing. If you have seen Shark Tank, for example, a lot of people who have come on Shark Tank are largely in the first two stages. You either have an idea for which you need money, or you have just started making the products, the prototypes. You are still what they call as pre-revenue. Then is the first stage, where you have started commercial production and marketing, which means the products are now being sold. Early stage. Now you are advancing into the second stage, where you are focusing on expanding money. So expanding a market, that is not typically where people come on Shark Tank, if you have seen that. These are slightly more venture capital. You have kind of generated more money. You have established a market, and now you want to expand in different geographies. You are earlier in a particular state, now you want to expand the geographies. The third stage, where you are expanding the market, maybe doing acquisitions, etc. And then is the last stage, where you do an IPO, or you do a sellout or a strategic acquisition. So this is the fourth stage. Okay, so these are the various stages. The risk is the highest at the seed level, and relatively lower at the level where commercial production starts. So from the second, third, fourth, the risk level kind of reduces. The investment horizon for you to kind of make profits is the longest in the seed money, if you are investing in the seed money stage, but the returns can also be phenomenally high. And it is the investment horizon is relatively lower in the fourth and the third stage. Aja. The second question, explain business model with the help of an example. What is business model? Well, business model is your capability to generate revenue, how your idea will be put into a process, and how it is capable of generating revenue. What is the market? Who are the customers? Who is the supplier? From where are they going to get the revenue? How are you going to pay your expenses? What is the gross margin that you are going to earn? All of these are a part of the business model. So over here, the business model is a wide term denoting core aspects of a business. So business model will denote the core aspects of a business, like the purpose for which it is there. Who are the target customers? What are the strategies? What is the organizational structure? From where are you going to source? Trade practices, everything. Basically, your entire business, from the purpose to from where you are procuring the materials, how you are setting up your organizational structure, to how you are going to reach out to your customers, establish a market, and generate revenue. Okay, business model is basically a way in which company generates revenue and makes profits from company operations. Okay, there's an illustration which is given, and I mean you can have a different illustration. So this is what is important illustration, you can put on your own way. So in this illustration, what happens is there is a company, there are two companies, both of them are, let us say, generating a particular level of profit. However, one company is using a digital medium, and as a result it could reduce its cost, whereas the other company still continues with the physical medium, and as a result its cost is higher. So even at the same level of revenue, one company, because of a slightly more flexible business model, can probably earn slightly higher profits or gross margins. This is something where, I mean, you don't need to write such a huge illustration. You can kind of just explain business model and an example of business model in your own ways, whereby by probably changing your business model or adopting your business model to newer technologies, you can probably reduce your cost or increase your sales and kind of improve your profitability. Okay, next you have this question where you are looking at various structures for a foreign investor. Now there are, let's read the question. This is MTP November 21. Explain the alternatives available to offshore investors for making investment in venture capital funds in India. Now there are two alternatives that are available. First is what is called as a unified structure. Second is offshore structure, or either ways. If you are looking at an offshore structure, what happens is a lot of foreign investors come together, set up of offshore foreign entity, and that offshore foreign entity directly invests in Indian portfolio companies. It might appoint an Indian advisor, investment advisor, but that offshore foreign entity directly invests in Indian companies. There is no domestic investor in an offshore structure. Second is what is called as a unified structure, where in a fund money is going to come from Indian investors as well as foreign investors. So what happens is these foreign investors come together, they set up a single foreign company, an offshore company, so that compliances are easier, and that foreign company invests in a trust in India. The domestic investors also invest in that trust, and that trust invests in Indian companies. So in an offshore structure, makes investments directly into Indian portfolio companies. Whereas in case of a unified structure, domestic investors are also expected to participate. Overseas investors pool their money in an offshore vehicle that invests in a local trust, where domestic investors directly contribute to the trust, and this is used to invest in local companies. So overseas managers, there's a trust in which their investment happens. Indian investors will directly invest, and investment can be done in portfolio companies. Okay. Next, in question 4, you have the definition of startup. It's the new definition of startup as per the 2019 change. So as per this, startup has to have 3 essential features. First, the startup has to be less than 10 years old. Second, the turnover in each of these years has to be less than 100 crores. And third, it should be involved in technological innovation, some new product development, creating new markets, solving a bigger problem, etc. So over here, the definition of startup: 10 years, turnover has to be less than 100 crores, and working towards innovation, development, or product improvement, as the case may be. So these are the definitions of startups. And the last question would be on angel investors. The question says, angel investors provide a more favorable terms than other lenders. Now, angel investors are different from venture capitalists. Angel investors are typically friends and families, or the acquaintances of a particular person who invest in really early stage. They are backing the idea, they are supporting, and they are typically at the seed stage or a very early stage. They are focused on giving funds at a very early stage to an investor, and they're not really looking at IPO, etc. So over here, India, let's say, the problems we are mentioning, that lenders, why do they not lend to startups? Because of slightly old rules, red tapeism, lack of general support for entrepreneurship. Things are changing. That is not still the case. Angel investors are typically among entrepreneurs, family and friends. They are typically one-time investments to help the business start. It is just the first wheels. They invest in the entrepreneur and not really in the business, because as of now there is no business, so they're backing the entrepreneur to create a business. So since they're usually investing in the entrepreneur rather than the viability of the business, because up to the business hai nahi, unlike other lenders, etc., which actually invest in the business along with the entrepreneur as well. Angel investors are informal investors. They're private investors, seed investors, or also called as business angels. They typically have their own money, unlike venture capitalists, which have like this offshore structure, etc. They've raised money from someone else. Angel investors typically invest from their own money, and hence there's a lot more flexibility. Okay, so I've tried to kind of cover the theory. Obviously, there are a lot of pages, a lot of stuff. We can't really go into explaining everything right now, otherwise it will take another 5 hours. So I hope this video has been helpful, and I hope you really do well and score really good marks. Wish you all the very best. Do well, and good luck. I'll share the PDF for all of these on Telegram. There would be a PDF where you have of, I think, 83 or 84 pages, which covers everything from the beginning. So if you're reading it for the first time, take that. If you have referred the first YouTube video and now you're referring the second YouTube video only, you have not done anything else, then you can refer the 50 or 60, I mean whatever pages were there earlier in the November 20 PDF, and then you can refer this additionally. And if you've done self-study on your own from the December 21 PDF that was shared on Telegram, then we have also shared another PDF where we just look at the additional questions for the May 22. I hope it is not as confusing as this entire. If you can manage SFM, you can definitely understand what to refer. Nevertheless, I'll stop for this session. Thank you very much for your time, and I'll see you soon. Good luck. Bye bye. Take care.